In today's video, we're going to dive in depth into one of retirement's most common tax obstacles. The reason this obstacle is so common is because everyone taking Social Security will face this as a potential hurdle. Now, we're going to explain how this obstacle works, how it transforms your tax brackets in retirement, and then hopefully show some strategies to help avoid these higher taxes. Now, first, there's a basic concept that everyone watching this video needs to understand so we can start building on from here. And that concept is something called a marginal tax rate. Now, marginal tax rate is the tax rate that you pay on a specific dollar of income. For instance, let's say you are someone on the edge of the 22% tax bracket. You add an extra $1,000 more of income through an IRA withdrawal, and that moves you into the 24% bracket. Now, just that extra $1,000 is being taxed at 24%. All of the dollars before that are being taxed at 22%, 12%, and so on. So your marginal rate on the last $1,000 that you pulled was 24%. The $1,000 before that was 22%. The reason marginal tax rate matters so much is because it informs our withdrawal strategy. If hypothetically we had a very high marginal rate of 50% on a given income distribution, we might want to consider other places that we could pull that distribution from to avoid that 50% tax rate. So the common tax obstacle we're going to talk about today is called the Social Security tax torpedo. And the reason it's called the torpedo is that it can really torpedo a retiree's tax bill. The purple zone on the graph shows the effect of this tax trap and shows why your marginal rate will rise 50 to 85% if you find yourself in this zone. As I present this tax trap to clients, I find it can be one of the most confusing obstacles that you will face. And so my goal by the end of this video is to give you the tools to fully understand how it exists and, more importantly, how to avoid it. Now, let's get a little bit into the weeds on calculating your Social Security taxability. This is a two-step process. The first is you will need to calculate out something called your provisional income. Now, provisional income takes into effect three variables: your gross income, which would include things like IRA distributions, pension income, capital gains, and more. You need to add in then muni bond interest, or otherwise noted as tax-exempt interest, and then you also need to add in half of your Social Security benefit. Now, for the sake of cleaner math, I'm going to use a $40,000 Social Security benefit here for a single retiree. I know that's a very high benefit, but again, it works out to simpler math on the back end. They have no muni bond interest, and they have $30,000 in IRA distributions and pension income. So if we plug all of this into the provisional income formula, pretty simply we get a PI of $50,000. Okay, simple enough. Now, this number doesn't mean anything on its own. We need to take this number and plug it into the table that I have on the screen. Now, this table is slightly different for a single filer and a married filer. Your provisional income and this table will determine your Social Security taxability. Now, we are going to focus on a single filer calculation in this video, but you can easily use the same logic to apply to a married filer's situation. Now, the biggest mistake I see retirees and advisors make is they think this table is a tax cliff. So you see on the right-hand side of the table, this 85% region for a single filer is at $34,000 of provisional income. Well, obviously $50,000 is more than $34,000. So does that mean instantly 85% of this filer's Social Security benefit will be taxed? And the answer is no. This is a sliding scale, not a tax cliff. In each zone, the provisional income in that zone is prorated by 50% or 85%. Let me explain with three quick examples showing different provisional income amounts. So let's say that you had a $40,000 Social Security benefit, but nothing else. So your PI, your provisional income, would be $20,000 because all that would count in that formula would be half of that Social Security benefit. Now, because $20,000 is less than $25,000 for the single filer threshold, this person's Social Security benefit would be untaxed, would be completely tax-free. Okay, easy enough. Now let's move on to scenario number 2, and now we're going to use a provisional income of $30,000. Now, $30,000 is $5,000 more than the lower provisional income threshold. And so what we want to do is we want to basically take 50% of this difference, and that will be your taxable Social Security. And so obviously this is a $5,000 difference. if we multiply by 50% or prorate that by 50%, we would have $2,500 of a taxable Social Security benefit. Then finally, we're going to take our $50,000 provisional income example. Now, first, this person is going to be fully taxed in that 50% zone because they fully span that zone. There's $9,000 in this zone, and if we take that 50% taxability, that would give us a total of $4,500. But we also see that $50,000 is $16,000 more than the upper threshold of $34,000. So 85% of this amount becomes taxable, which gives us an extra $13,600. If we add these two together, we get a total of $18,100. And so of a $40,000 Social Security benefit, this person would only have $18,100 of it actually taxed. Again, assuming they had that extra $30,000 of IRA withdrawals. Now, if we were to put this all together and calculate out your tax bill, you would take that $30,000 of IRA distributions, you would add in that taxable Social Security benefit, and your total adjusted gross income would be $48,100. After the standard deduction, and we would add on an over 65 add-on here, your total taxable income would be $32,400, and you would find yourself in the 12% bracket. Now, here's the tough question. Is 12% your marginal tax rate? And the answer might surprise you, but the answer is no. And here's why. Now, humor me for a second, and let's re-walk through this calculation, but now we're going to increase the IRA distribution by $1,000 to $31,000 total. This would lead to $1,000 extra of provisional income. But what would this do to Social Security taxability? Well, remember that we're in the 85% zone. So $1,000 extra of provisional income gives us $850 extra of Social Security benefits that will be taxed. So we have $1,000 of IRA distributions being taxed, but then we have to add in the $850 of extra Social Security benefits being taxed. $1,000 of extra income then leads to $1,850 of extra taxable income. And so if you're in the 12% bracket, this $1,850 costs you an extra $222 in taxes. But here's the thing. This is all a result of taking an extra $1,000 from your IRAs. So to find the marginal tax rate, we'd actually take that $222 and we divide it by 1,000 for a marginal tax rate of 22.2%. Now, you think you're in the 12% bracket, but we can readily see that that's not the case, and that's because of this double taxation effect. And so because of this effect, your marginal tax brackets in retirement look a whole heck of a lot different than your normal income brackets looked while you were working. Specifically, notice where tax hikes come in. It's not that the top income bracket increases and therefore only affects the wealthiest of us. Rather, it's the small income brackets that are replaced and are increased and will affect most retirees to some extent. It's also worth noting that we expect these marginal rates to look a lot worse come 2026 with the sunsetting of the Tax Cuts and Jobs Act. And so once you're on Social Security, know that the 10 and 12% bracket essentially disappear. They no longer exist, at least for you. Now, a couple things to keep in mind with this tax trap. First, the larger your Social Security benefit, the larger the tax hike zone will be. This is because the larger your benefit, the longer it will take to get to full Social Security taxability, which is 85% of your Social Security benefit. Now, some will hear this insight and think, geez, then why wouldn't I file at 62 and try to make sure I gain the smallest Social Security benefit to avoid all of this complexity altogether? And this would be the exact wrong conclusion to derive from this insight. Although a larger Social Security benefit lengthens the tax hike zone, it also pushes this zone out at further gross income levels. For instance, let's use the past example of a retiree needing $70,000 of income. In a hypothetical situation, if a single retiree could have a $70,000 Social Security benefit, this would be fabulous tax-wise. They would owe $0 in taxes when considering the standard deduction, and they would avoid the Social Security tax torpedo altogether. Versus the example we already walked through gave them a taxable income of $32,400, and they found themselves in this torpedo zone. So larger Social Security benefits are certifiably better here. Second, know that single filers will find themselves dealing with this Social Security tax torpedo faster than married couples. For instance, at $40,000 worth of IRA income, this single filer would be in the 40.7% zone here. If we take a married couple with, let's just say $65,000 of combined Social Security income, they would have to show about $70,000 extra of IRA income to reach the 40.7% zone. So a single retiree can show roughly $80,000 of total income, while a married couple could show $135,000. Now, keep in mind as we walk through this that one person in every married couple will end up finding themselves in the single filer zone, or at least making those single filer calculations due to the widow trap. When someone passes away, that single filer goes from the married filing jointly brackets and down to the single filer brackets. So understanding these shifting tax dynamics is important. Now, I'll leave you with one more variation on this common tax trap, and that's looking at this marginal tax graph when we add in things like dividends and capital gains. Now, dividends and capital gains are taxed at preferred rates, but stack on top of all of your other income. So at low income levels, this income, this capital gain and dividend income, will be tax-free for a retiree. But as they shift their income higher, they will move from 0% taxability to 15% taxability. And this creates another large tax zone. Effectively, this stacks on top of the already high tax rates this retiree would be paying. Now, what happens here is that you have the same $1,850 being taxed at 12% that we discussed, the calculation we walked through before, that is basically creating that 22.2% tax bracket. But if we add $1,850 of taxable income, what that's going to do is it's going to displace $1,850 of capital gains that was previously taxed at 0%. It's now going to move it into being taxed at 15%. Now, I know there are a lot of moving parts here, but what happens here is you end up with a higher marginal rate of nearly 50%. You have the Social Security tax torpedo on one hand, but then you also have your capital gains moving up into that 15% bracket on the other hand. And so this high marginal rate of 50% would all happen at less than $80,000 worth of total income for this single filer. And so here are a few tips to avoid all of this tax madness. First, be aware of your RMD, especially for married filers. Most married filers won't find themselves in the worst part of the Social Security tax torpedo unless they have an RMD that's pushing them up. As I showed before, at about $135,000 of income, you would start to see that 40.7% zone in the specific situation I showed. Now, understand that the Social Security tax torpedo looks different for every situation based on the Social Security benefit that a couple or specific retiree has. But your required minimum distribution is the single most common thing that forces retirees into these high tax zones. And obviously, Roth conversions, which we talk a ton about on this YouTube channel, can help avoid large required minimum distributions. Second, make sure you're factoring in guaranteed income like pensions and annuity income. You may have a pension that eats up all of the low tax zone space that you have available. So any IRA distributions might push you into the worst part of that Social Security tax torpedo. Now, factor this into your forward-looking tax plan because this probably means that we want to be a little bit more aggressive with Roth conversions, or if you're charitably minded, we want to use things like qualified charitable distributions, QCDs. Lastly, and I'll harp on this again as I've done in past videos, you need an annual tax roadmap that lays out the charts that we've shown in this video. This is the only way to truly understand and avoid ongoing tax problems. Many retirees push themselves into this Social Security tax torpedo without even realizing it. They think they're in the 12% bracket. In reality, they're in the 22.2% bracket. Now, I hope you like this in-depth breakdown, and hopefully it offered a little bit more clarity on this complex tax obstacle. If you're looking for a simple guide to help you design your withdrawal strategy, to help avoid this tax hurdle as well as many others that we talk about in past videos, we talk about a simple basic withdrawal strategy in this video right here. We talk about the 3 tax buckets that you have and how to coordinate them together to deliver significant tax savings to your situation. Thanks for watching this video, and always remember, you don't need more money, you need a better plan. We'll see you in the next video.